Amazon will report their quarterly figures 1 week from today, Thursday, May 1st. Amazon has lately become my largest position in the core portfolio, surpassing Tesla, and actually Meta is very close to become the second largest position in that portfolio. So in this video, let's touch on what the market is expecting Amazon to report, the current state of the company, valuation, pricing wise. We're going to talk about all of that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much, and a special thanks to FinChat as well for supporting this video. Alright, so first up, a quick overview of what's going on right now in the market. At the time of making this video, a lot of green here, a lot of green across the board, so that's great. But of course, by the time you're watching this, a lot of things can change. Tariff news, non-tariff news, we are talking with China, we're not talking with China. Every single day it's something else. It would be great if for the next couple of days, maybe next week or so, we'll hear very little about tariffs, right? Just stay quiet, blackout period, talk about it in the background, talk about it not in public. I think that would be very, very well received. Now, as you know, today after the market closes, we have Google, Alphabet reporting and Intel as well. Before the market opened, we already had Mobileye, so I'll cover Mobileye in the Intel video, and then we're of course going to cover Google, Alphabet. All right, so Amazon at the time of making this video is at $181.6, has a market cap of $1.92 trillion. Now, currently, as you can see, the current drawdown that we're experiencing is around 25% from the recent peaks. Year to date, the stock is down over 17%. Now, valuation wise, yes, if you look at trading PE, that sits at 31.3 times, not the cheapest one out there. Forward PE sits at 27.7 times. Now, as you know, the forward PE, the forward earnings expectations might definitely change based on, next week's earnings report, commentary on the call, and then especially because of the analyst expectations. Expectations can go up and can go down, and that's how, that number right here is going to go up and down as well, depending on, what the stock price does. But to me, Amazon is one of the best companies on the planet. I'll show you why. I've shown you why in other videos as well. Now here we are on a FinChat. Of course, I've been using FinChat for quite a while. It is a stock research platform, probably one of the best out there, if not the best out there at the moment. So you can go and look at what the market is expecting Amazon to report next week. As you can see right here, consensus figure sits at $155 billion. The range is $152 to $158 billion for revenue. Remember, last quarter guidance was a miss. They did say that that's because of FX headwinds, which to be honest might turn into tailwinds with a weaker dollar, although a large part of the revenue does come in US dollars. Looking at EPS expectations, that sits at $1.36. The range here is $1.07 to $1.52. One extra metric I want to look at, and that's free cash flow expectations. So here the range is quite crazy. The consensus figure sits at $2.67 billion. But if you look at the range, that goes from negative $7.6 billion all the way to $11.29 billion. Now, of course, with Amazon, if you want to look at company-specific metrics, because this is one of FinChat's greater strength, is to look at segments and KPIs for various companies. So if we look at Amazon here, for example, we just want to focus on AWS revenue and revenue growth. We can click on those things right here, and you get that for the last, 10 plus years. And as you can see, last year we have seen it rebound. We have seen growth re-accelerate. You can do that with all of the segments here. We can do that for North American revenue, right? That's also going to be probably an interesting topic to talk about because, Amazon, as it was reported, that a lot of the sellers on Amazon's platform are Chinese sellers. So how is that going to impact, the business going forward because of all the tariffs? Now, with regards to North American revenue, we can see that it has been decelerating. The growth has been coming down year after year. If we look at the international segment, we have seen a rebound from the lows here of 2022, although last year growth did decelerate a little bit, closer to 9% compared to the 11.2% we've seen in 2023. So if you want to try FinChat out, you can use my link down in the description and in the pinned comment to get 15% off. All new users will of course get 2 weeks of FinChat Pro for free. Now touching back on something I mentioned in the portfolio update on Sunday, if you look at Amazon, incredible company, right? The business has become better and better, more profitable over the last couple of years. Yet its performance here compared to the S&P 500, well, is that it has been underperforming. So yes, in the last couple of years, a lot of companies have either barely outperformed the market, or in this case, great companies are underperforming. Now, Amazon, of course, you can see this is a company that has no issues expanding its total addressable market, right? Whether it's online stores, of course, started with that, physical stores, third-party seller services, then advertising, then subscription, and then AWS. Healthcare is the next one. And then, of course, with Project Kuipers, that might be, well, the next Starlink. So it is a company that is expanding its total addressable market and has been quite successful doing so. Now, the stock might not reflect reality, as we can see right here. If you look at earnings per share in the last 12 months, then if you look at the stock price, well, usually it did follow the stock price. But right now, there is a disconnect. Now you might say, yeah, but that disconnect makes sense because of tariffs, right? Because of the potential big hit that the Amazon.com platform might experience. I'd say, yeah, okay, there is some risk, but as I've shown you time and time again, the faster growing, higher margin businesses are, well, where the money is at. For example, AWS last year, over $100 billion generated in revenue. If we look at the growth rates, right, for AWS, Google Cloud, and Microsoft Azure, yes, AWS is only growing 19%, which is less than Microsoft Cloud and Google Cloud, but it is 19% year-over-year growth on a much larger number. Speaking of AWS and maybe AI investment, remember we've had that story about Microsoft maybe canceling some leases, and now more recently we've had that as well for Amazon, more specifically AWS. So here we have Kevin Miller, the Vice President of Global Data Centers at Amazon, saying the following on LinkedIn. There continues to be significant interest and speculation about the data center expansion plans of AWS and other cloud providers. So I thought I'd share some of our thinking here. First and foremost, we continue to see strong demand for both generative AI and foundational workloads on AWS. We have almost 2 decades of experience delivering data center capacity to meet customer demands when and where they need it. That experience has taught us to consider multiple solutions in parallel. Some options might end up costing too much, while others might not deliver when we need the capacity. Other times, we find that we need more capacity in one location and less in another. This is routine capacity management, and there haven't been any recent fundamental changes in our expansion plans. Fortunately for our customer, they're able to focus on their business and leave these details to us. So here, again, going against those reports, same as Microsoft. 2 extra things here. Amazon is on track to generate $1 trillion in revenue probably by 2030. Last year, that was $637.9 billion. If we look at gross profit margin in the last 20 years, that has gone from 24% to 48.9%, whereas free cash flow margin did come down a little bit. 20 years ago, we were at 6.2%. We're now at 5.2%. Of course, we were lower before, we're actually negative for 2 whole years here, 21 and 22. But what's impressive is that one, of course, CapEx has increased, well, a significant amount over the last 10 plus years. The company as a whole has, of course, grown a lot over the last 10 plus years. So gross profit margin did increase and did more than double over the last 10 plus years. But free cash flow margin has stayed, let's say, flat over the last 20 years or so, despite CapEx now reaching, what is it here? $83 billion. So imagine what happens when CapEx starts to decrease. Imagine what will happen with free cash flow margin, right? The business stayed the same, and that's what we've seen here. That jump from negative 3% to 5.6, 5.2%. This is them showing the underlying profitable business that they have. Right now, of course, they're investing quite a lot in infrastructure, AI infrastructure. What happens when that cycle is over or is slowing down? Well, of course, the profitability profile of the company will become better and better. And this is what we have experienced right here, right? If you look at international operating income and even North American operating income, right? There was a period where each and every quarter that was negative, that was operating loss. And then they flipped the switch and suddenly we have more and more operating income, right? We went from $2.5 billion in operating income, with the majority of it coming from AWS, to now $21.2 billion. So all in all, to conclude, should you buy Amazon before the earnings report or after the earnings report? Well, the golden rule for me is pretty simple. If you really want shares in a company, there's no reason to wait until after the earnings report, right? You can open a very small position before. If it goes up, great, your position is now up. You also have more information, then you can continue to add. If you have a small position and after the earnings report, it goes down, then okay, your small position took a little hit, but now you can buy more shares. Of course, you can play the option game as well. That could definitely be very helpful in this situation, but options, well, more volatility is to be expected, and extreme volatility is to be expected, of course, in the next coming weeks. We have the earnings season, plus we still have all this tariff talk. Me personally, I've been adding Amazon, well, before in the last couple of weeks or so. So to me, there's no discussion here before or after the earnings report. Right now, it's my largest position in the core portfolio. So that question to me doesn't make sense anymore. But if I were looking to open a position, I think that is the strategy I would use. Of course, it's all up to you. There are plenty of companies that will report in the next couple of weeks. We don't have unlimited cash, so it's really up to you what you want to get exposure to in your portfolio. So do let me know what you think down in the comment section below. Like, subscribe, all of that, and I'll see you all in the next one. Bye bye.